Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Sumit Roy, Senior Analyst here at ETF.com. This week, we're talking about Vanguard's fee cuts, along with Trump's tariffs and a brand new currency ETF. As usual, on today's show are my wonderful colleagues, Research Lead Kent Tooney and Wealth Management Editor Jeff Benjamin. Great to be here with you guys.
Great to be here as always, Sumit.
Glad to be here too.
Definitely. So, Jeff, we got to talk about the Vanguard fee cuts. I know technically these happened last week. We did cover it on our site, but not on last week's podcast since we were busy talking about Canada and Mexico. But judging by the traffic we're seeing on some of our articles related to this, this is something investors really care about. So for people who don't know what happened or want some extra color, why don't you get us up to speed with what went down, Jeff?
Sure. This is something investors and financial advisors should care about. It's lower fees, which is always good news for investors and financial advisors. What Vanguard did at the end of January was they announced some sweeping cuts to 53 of their 88 exchange traded funds. I think they might have 90 exchange traded funds now. They just launched a couple more this week. But anyway, the fee cuts were, basis points in the basis point ranges, but it's just another example of Vanguard doing what Vanguard does. They're renowned as the low cost provider. They've put pressure across the asset management industry, the financial services industry. And the conversations that I had with people were along the lines of, this is how Vanguard's going to continue to compete. They only have, I think, 6 actively managed funds. They're not showing a lot of interest in moving in that area. They're not jumping on the crypto bandwagon in any way, shape, or form. They actually stiff-arming crypto. They won't let you even trade crypto ETFs on their platform. They're certainly not launching a crypto ETF. So what they're doing is trying to gain more market share where they don't have the most market share. And some of those areas are going to be in the thematics space, likely. You're probably likely to see them put a little more pressure on the thematic strategies that they have and roll out some more thematic strategies.
So, Ken, you're an advisor. How do you look at these fee cuts? I imagine you already looked at Vanguard pretty favorably. These fee cuts have to make you look even more favorably at Vanguard funds. Isn't that right?
Sure. Yeah, I definitely agree. Now, there are cases where an advisor won't necessarily make a switch from one ETF to another because of low expenses. A prime example would be, say, a taxable account where let's say a client has held an ETF for 10 years and they have $20,000 of capital gains on that. And if we sell that, then there's going to be capital gains tax just so you can save 1 or 2 basis points. So that's not incentive enough to move. But to Jeff's point, it just reaffirms and confirms that Vanguard is the low cost leader. So if you're buying shares of a new ETF, like they have some actively managed municipal bond ETFs, those type things, you feel comfortable and confident that they're going to compete on expenses in the future. So the best beneficiaries are going to be those who already hold the shares of the ETFs. It's kind of just like getting an extra discount. It's almost an incentive, like, say, dividend paying companies and stocks that in the future that they're going to keep doing that. So you want to hold it for the long term. So, I mean, Vanguard just reestablishes themselves or reaffirms that they're the long-term low-cost leader.
Absolutely. So this is obviously good for Vanguard investors. They're saving what is, according to Vanguard, $350 million from these fee cuts. And it's obviously also good for Vanguard's mission for delivering the best outcomes for investors. But someone who it's not good for is BlackRock, the world's largest asset manager. Another angle that people are talking about is the fact that BlackRock is going to be hurt by this. We saw on the day that Vanguard announced the fee cuts, BlackRock stock dropped 6%. Jeff, I know you're skeptical that this will truly have that much of an impact on BlackRock's business. Am I conveying your opinion correctly there?
Well, yeah, I mean it's Vanguard. They're not small. They've got $9 trillion under management, 2.7 trillion in ETFs. But BlackRock is still the the giant in the asset management space, the world's largest asset manager. Pressure is pressure. Vanguard's not known as an expensive place to invest anyway, but obviously the pressure will be applied, and we'll probably see some movements across the ETF space of fee cuts where it's applicable or where it's appropriate. But um, it's hard to imagine that Vanguard's fee cuts, not like they went from 50 basis points to two, was going to have that much pressure on a company like BlackRock, which is broadly diversified. And it's hard to imagine that one day or even 3 weeks worth of lower fees is going to put that much pressure on BlackRock's stock price. I talked to Kathy Seifert she's an analyst covering BlackRock over at CFRA. She says that there's probably other things putting pressure on BlackRock shares, including inflation. Also, she said that BlackRock's strategic shift into alternative assets and private credit is likely to be a bigger needle mover in a positive way as far as the fee cuts by Vanguard. Um, so yeah, to me this seems like a little bit of a fringe issue for a company like BlackRock. It would be different if BlackRock was known as the high cost provider, but they're not. They've got a lot going on there, and there's other things driving BlackRock shares in that way. They really are a high beta stock, and
Yeah, yeah,
that's kind of a market thing.
definitely. And we should also mention that BlackRock stock was trading at an all-time high the day before Vanguard's fee cut. So maybe this was just an excuse to take profits. There is, some impact potentially on BlackRock's earnings. I was reading a Wells Fargo analyst note on what went down, and they essentially modeled a 1 basis point cut to some of BlackRock's funds that compete with the Vanguard funds that had the fee cuts. And they said, if you assume a 1 basis point cut in these BlackRock funds, the hit to the earnings per share for the company is about 3%. It could have some impact. We'll
That
see.
is interesting. Yeah.
Yeah. Yeah. So we'll see how BlackRock responds. Maybe they might not cut fees at all. Maybe they'll reduce it slightly. There's a lot of uncertainty there. But yeah, in the grand scheme of things, BlackRock stock is, just a few percentage points off the all-time high. So yeah, we'll be keeping an eye on that. BlackRock, Vanguard, two very important companies when it comes to the ETF industry. I think this is a good place to shift gears a little bit. As usual, we have to kind of touch on the macro news of the week. I know we've been talking a lot about tariffs, but every week it seems like there's some new development when it comes to trade. The latest is Trump's proposed 25% tariffs on steel and aluminum. Ken, you wrote about the ETF impact from this. Can you tell us about that?
Sure. So yes, earlier this week I was reporting on that new round of tariffs on aluminum and steel, and the only ETF dedicated to that, the Van Eck Steel ETF SLX is the ticker, rose following the announcement just because it's going to make or expected to make U.S. based steel companies like Nucor, United States Steel Corporation, more competitive. And so investors like that. And so that ETF rose over 3% on Monday. But on the flip side of that coin is just the concern over potential inflation. So you're seeing some of the, say, rate sensitive bond ETFs having more downside pressure this week, such as TLT. We ride on that one a lot. It's a super popular Treasury ETF, iShares 20 plus year Treasury ETF. And then that throughout the rest of the week, there's other macro things coming out, like the CPI, which was much hotter than expected. TLT dropped about 1.3%. And then following that, which is Thursday, we have some other macro reports. That the main thing that fixed income investors liked was that the unemployment rate dropped down slightly to 4.0%. And that's a major economic gauge that fixed income investors are watching, because the Fed continues to say, repeats consistently, they're watching unemployment, and they're not going to be able to move much on rates in the downward direction until they see unemployment come down. So fixed income investors like that, and that's now TLT's up 1.3%. So we continue to see this volatility. Back to the tariffs, there's a lot of unknowns there, because it's really hard to say what the impact will be, and we won't know that until a lot of these issues are resolved, and then we can see how they may be hitting corporate earnings, or what it really does to yields long term, or even if these tariffs stay in place a long term. So we're going to continue to watch these things, obviously. So it's a developing issue with these tariffs and economic reports.
Yeah, absolutely. And you mentioned SLX, Kent. It did go up 3.3% on Monday. Then it dropped back down about 2% over Tuesday, Wednesday. So it's essentially only up 1.5% or so on these new tariffs. So, it's I wrote about this as well, and the impact is kind of ambiguous, right? You might get the 25% tariffs on steel and aluminum, but you look at something like SLX, and only 50% of the holdings are US based companies. So presumably those are the ones that are going to benefit from the tariffs, because they're not affected by the tariffs. But on the other hand, the other 50% of the portfolio, the foreign companies, would be affected by the tariff. So those would kind of offset each other. And I don't know what the overall impact on that portfolio would be. So I guess that's the problem with buying a global portfolio of steel companies. You're not going to benefit as much from those steel tariffs. That's why I wrote in my piece, if you really just want exposure to domestic steel companies, you're better off buying a handful of individual stocks. I'm not saying you should go out and do that. It's probably, priced in by now. But if that's what you want, there really isn't an ETF for you. I know we talk about there being an ETF for everything, but in this case, there's just not demand for a domestic steel ETF, so we don't have one on the market. If you do go ahead, Jeff.
Well, no, I was just on the tariff topic in general. We talked about this a little bit last week, and my position is the same. I feel like this is less about the actual application of the tariffs than it is about the noise. And that's what's moving some of these ETFs. We talked about, earlier this morning, we were talking about the Direction Daily FTSE China Bull 3 times shares ETF, ticker YIN, YINN. This thing is up 138% over the past 12 months. It's up, let me see here, it's up 32% this year. But this is a trading vehicle. This is basically, you talk about the threat of tariffs on China, and right now it is still a threat. There are some tariffs in China, but the increased is what we're talking about. These are trading vehicles. This is, to me, it seems like where the opportunity is right now. If you're going to focus on tariffs, until these things are applied and we know what it's ultimately going to look like, it's all just volatility and noise. Either get in there, roll up your sleeves, get some of these leveraged or inverse exposure and play around, or don't. I don't see any advantage in trying to buy a kind of a long only, exposure to one of these countries or one of these industries or sectors based on what we're seeing right now, which is just noise. You got to let the dust settle. You either play it or you step back.
Yeah. No, I agree with that. And, we're looking at an S&P 500 that's only a 1.5% off the all-time high. The impact from tariffs so far has been very negligible, though obviously that could change down the line. We don't know. Kent, you talked about the CPI and all of that stuff. Obviously, the tariffs is kind of tied into that. Some people worry the tariffs could cause consumer prices to accelerate. I don't think we've necessarily seen that so far. The CPI number that we got earlier this week, which showed higher than expected inflation in January, I think a lot of people are attributing that to companies raising prices at the start of the year, kind of like what they did last year. And then presumably we'd see inflation cool as we move throughout the rest of the year. At least that's the optimistic take that people have. And clearly, given the S&P is near the high, that's what people are kind of believing.
Right. Yeah. I wish I had the name of the Fed chair, but I saw one of the Fed chairs yesterday was saying, hey, don't overthink the CPI. And I agree with that. And to Jeff's point and your point too, as well, Samit, all this really is noise. And short-term traders are just speculating on what's going to happen. And the impacts from the tariffs are yet to be seen, and they're yet to be seen in any inflation report as well. So it's a trader's market, and for most of us, it's wise just to step out and not pay too much attention to it.
Yeah, and fun fact, egg prices rose 15% just from December through to January, and they're up 50% year over year in January. And that was responsible for a huge portion of the food inflation that we saw in January. Of course, that's because of the bird flu that's going around. Just a crazy stat on egg prices. Has nothing to do with tariffs, of course.
Yeah, eggs. I gotta say, a fun fact is while we're dishing out fun facts, I live here in North Carolina, and a good friend of mine has several dozen chickens, and I can't remember the last time I bought eggs. I've offered to pay for the eggs that she gives me, but she's too wonderful a person. She keeps giving them to me. So I feel your pain, Samit, on your egg prices, buddy.
I mean, those are the best kind of eggs, fresh eggs, and you can't beat that.
Yep.
And free. That's even better.
Yeah. Yeah.
Yeah. All right.
Exactly. So, guys, I think it's a good time to hit our last segment. Jeff, you wrote this story on this new ETF. It's called the Simplified Currency Strategy ETF, ticker symbol FOXY. It kind of caught my eye because we don't see a lot of new ETFs when it comes to the currency arena. This isn't a very active part of the ETF market, but this one is kind of unique, isn't that right?
Yes, it is well, I'm gonna explain the strategy here, and then we'll talk about how it kind of was timed opportune to volatility in the currency markets that might be in some part attributable to our current president, but that wasn't timed. It was just good fortune, I guess. But anyway, so this is not a strategy that bets on, or the strength or weaknesses of the U.S. dollar. It's basically a hedged strategy. It's actively managed. It's divided into emerging markets and developed G10 currencies. On the emerging side, it takes four currencies. The four currencies with the highest interest rates will be held long, and the four currencies with the lowest interest rates are shorted. And the same strategy is applied on the G10 side with three long and three short. But like I said, this is a strategy to play currency volatility. And currency, as you know, is it's always paired against one or another. You can't say the dollar is strong without pairing it against something else. So, and that volatility is ticking up a bit and expected to continue to tick up a bit under many or some of Trump's policies. So that's what this is. And I talked to those people over there. They said they didn't time this to what President Trump is doing or likely to do. But increased currency volatility is not going to hurt this strategy. It's 75 basis points, by the way, is the expense ratio, and they describe it as dollar neutral, meaning what I said earlier. It's not betting on the strength or weakness of the U.S. dollar.
Gotcha. It kind of sounds like the carry trade, Jeff, where you're borrowing in the low interest rate currency and you're kind of buying into the high interest rate currency. I know that's a popular strategy in the currency space. I wonder if it'll work or not. I guess time will tell, right?
Yeah, time will tell. It's brand new. It was launched February 4th. So it's brand new. Not a lot of money in there yet, but I'm telling you right now, they've got over at Simplified, they have hired some serious people to manage these kind of strategies. They got let me get their names, Ken Miller and Chris Getter, both PIMCO veterans, where they manage these kind of strategies. So there's a lot of smart people over there behind this strategy, and it is, like I said, it's actively managed. So it's not for the meek. I'm not saying it's going to be extremely volatile, but it's playing on the volatility in the currency markets.
Absolutely. We'll be keeping a close eye on that fund. Like I said, currency ETFs, not an area we tend to see a lot of action or a lot of assets right now. If you exclude the cryptocurrency ETFs, the biggest currency ETF is the Invesco Currency Shares Japanese Yen Trust, FXY, $400 million of assets there. We'll see if this new fund can reach those types of levels. Well, I think that's a great place to wrap it up. I want to thank all our listeners for tuning in to Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.